I'm Dan Fitzpatrick at StockMarketMentor.com on Monday, June 10th. And in this video, I want to look at Diamond Foods. Earlier today, here's the deal. The company announced third quarter results that were pretty good. They beat estimates, but they also, and this is the real important part, this is why you see the blue marks up here above the 200-day moving average. They also restated second quarter earnings. If you recall, and you probably don't, they had some real squirrely crap going on back here. They had apparently made some, let's just say, some shady payments to some of their producers. Ultimately, the CEO and I believe the CFO had to resign because their accounting was just, let's just say, not particularly good. Whenever there are accounting irregularities, you run for the hills. That's pretty much the rule. I don't know if it's written down anywhere, but you know that's what you're supposed to do. Well, look, right now, at least as of the middle of last month, 31% of the float was short. This had a short interest ratio, in other words, like the number of days that would have to elapse before all the shorts could cover. If the entire volume on the day was shorts covering, was over 24 days. So this is like just a powder keg, just waiting for a little spark. That's the way I see it here. So here's how this is really this could be a gap and crap. I don't think it will be because of the shorts, because of how much short interest there is in here. But this stock could gap up tomorrow morning and then fall. Or it could gap up and run. What I don't see it doing is gapping up and pretty much sticking around at this price level. It's going to do one or the other. So what I'd suggest you do is you watch and see how this thing opens up. If it keeps going right from the get-go, then go ahead and then just say, okay, it's a short squeeze. I get it. I know what's happening here. So you go ahead and buy the stock. Feel free to chase it. You keep a stop. Again, this is assuming the stock gaps up and continues to run. If it gaps there and it's just staying there, then don't do this. But if it gaps and continues to move, then you go ahead and buy some stock, but you keep your stop like right below that intra-day low, that intra-period low, whatever you want to call it, over the first 5 or 10 minutes of trading. That way you're long a stock that all the shorts are scrambling to cover and you're right in there with them buying this stock. But if the stock falls back into the gap, that's when you'll say, okay, well, I guess there weren't that many folks that needed to cover, or maybe there's just so much supply that it's time to get out of this stock. And then you take it for a small loss. One of the biggest mistakes, probably the biggest mistake that traders make that keep them from becoming old seasoned traders is they don't know how to take losses. So you just stick with the trade until it works out. Problem is for all those folks who used to trade and don't any longer, it's because the trade that they were sticking with that didn't, that they were waiting for it to work out, well, they're still waiting. Don't be one of those guys. If this thing falls back into the gap, then I want you to go ahead and get out. But as long as it stays above, certainly above the 200-day moving average, then I actually think this is a stock that you can buy because it's going to move higher just on the broken backs of all those bears who are going to have to scramble to cover their shorts. Also, isn't this a pretty nice base here? I think so. Okay, members, get over to the strategy session.